Space exploration naturally burns capital, but the scale of infrastructure SpaceX is suddenly targeting demands a completely different kind of financial machinery. This diagram compares historical public offerings. SpaceX is aiming to pull in up to $75 billion. To put that in perspective, the previous global record was set by Saudi Aramco in 2019 at roughly $29 billion. SpaceX wants to more than double that. That capital raise implies an overall valuation for the company sitting directly at $2 trillion. For nearly 2 decades, Elon Musk insisted on shielding SpaceX from the public markets, a strategy designed to insulate long-term timelines from impatient shareholders. But a recent merger with xAI introduced a new infrastructure mandate. The company realized it needs to construct vast orbital data centers to train and run future artificial intelligence systems in space. The capital required for this orbital data infrastructure is measured in the tens of billions, shifting the company's internal financial math into a scale that few private entities have ever navigated. To secure the infrastructure for the AI era, SpaceX has to abandon its original corporate ethos and tap into the deepest capital pool on the planet. To go public, SpaceX had to submit a 277-page filing to the SEC. For the first time, the internal financial health of this highly guarded aerospace conglomerate is fully visible. This chart maps wild bottom-line swings. After a $791 million profit in 2023, SpaceX burned cash, logging a massive $4.94 billion net loss in 2025. Yet top-line revenue expands aggressively, projecting steady scaling from $14 billion up to $24 billion. Wall Street typically measures this kind of growth against market hype, using the price-to-sales multiple. It divides a company's total market value by its annual revenue to determine exactly what investors are paying for every dollar actually earned. This graphical breakdown highlights the discrepancy. Top-tier tech giants like Tesla and Nvidia generally trade at about 15 times their annual revenue. At a $2 trillion valuation, SpaceX requires a multiple of 87 times. Part of that premium is grounded in actual global dominance. The Starlink satellite constellation operates an effective broadband monopoly in low Earth orbit, delivering a proven, functional product to the ground right now. But the math of an 87 times multiple requires pricing in years of flawless future execution. Investors at this tier are paying for the speculative potential of Mars colonization and orbital AI servers, heavily diluting the value of the broadband revenue they generate today. Convincing active stock pickers to mundanely buy a highly volatile, deeply unprofitable aerospace firm at an 87 times premium is a difficult sales pitch. Historically, public markets solve this with a seasoning period. A newly listed company has to spend 3 months proving its liquidity and profitability on the open market before major indexes will consider adding it. SpaceX circumvented this hurdle. They secured an agreement with NASDAQ to bend those historical rules, fast-tracking the stock directly into the NASDAQ 100 index immediately upon listing. This flowchart illustrates the true value of index inclusion. Trillions of dollars from pension funds, retirement accounts, and everyday 401ks flow automatically into passive index funds like QQQ, which blindly track the top 100 companies without any human stock picking involved. By entering the index on day one, institutional algorithms and retail funds are mechanically forced to purchase the stock. The exact valuation logic no longer matters. The buy orders simply execute. Through this fast-track arrangement, SpaceX bypassed the traditional mechanisms of market scrutiny. Everyday retirement accounts will now act as involuntary venture capital to fund their orbital expansion. Securing guaranteed capital solves the immediate funding crisis for their AI ambitions. But operating as a publicly traded company introduces a direct threat to SpaceX's core engineering methodology. Every major initiative driving this $2 trillion valuation relies completely on the success of Starship, an immensely complex, fully reusable heavy-lift vehicle. Getting hardware like that to function requires rapid iteration. The company explicitly relies on a cycle of aggressive trial, error, and literal explosions on the launch pad to gather data and improve the next build. That philosophy directly conflicts with the demands of public shareholders. The stock market heavily penalizes failure and demands steady, predictable, short-term profit maximization. As other private AI giants like OpenAI or Anthropic reach similar scales, the SpaceX model suggests a future where mega-cap companies enter the public markets as fully formed, dominant players. The market is currently betting that Elon Musk will successfully execute on these timelines. If those heavy hardware tests fail to produce results, the $2 trillion price tag is entirely unanchored from reality. By embedding the stock directly into passive indexes, the financial stability of millions of American portfolios is now strapped directly to the volatile, highly experimental trajectory of a developing rocket.